Hello guys, welcome back to Wealth Workout. So we'll be discussing about how to value Shopify. Now this company is into tech, basically software as a service, and it has a lot of revenues. It's also growing steadily and has a very good revenue growth rate, but it's still not profitable. And yet its share price is so high. Why is it? So we'll be talking about that today, and we'll be talking about how to value it using proper methodologies and discounted cash flow model. And before that, I'd like to thank each and every one of you who shows support by liking our videos, and it means a lot. So if you're new to this channel, please watch this video, and if you like this video, do consider subscribing. Thank you. Let's get started. So this is Shopify, a worksheet that I prepared for valuing this company, and I'll walk you through it, but not entirely in this session. So this is a very big task for those of you who do not understand valuation at all, but this sheet will easily help anyone use the spreadsheets and data out there on the internet to value any company. So we have some inputs here in this input tab. Then we go to the valuation output. Some fields get calculated based on our inputs, and as you go down, you get the estimated value per share. Now we valued this company when it was at $914, which is a few days back, and I sent it to my colleague or a friend, and you can look at that. It was at a very high peak price initially. It fell down, and it was at this price somewhere over here where we valued it. And right now it has gained some amount today, but for the last 5 days it fell, and it has been falling. And this will continue to happen because sometimes companies are overvalued. Now, why do we need to understand what's happening here? First of all, we need to know what the company does. For that, let's go to Shopify's pricing page. You can see they charge monthly fees to their users, and that is basically a recurring revenue. So whichever user is making good money from Shopify will not hesitate to pay it, and they're going to be happy paying. So Shopify has a very good business model whereby people make money and Shopify earns too. They also charge transaction fees, and that is one more source of income for whatever transactions take place and are carried out through Shopify. So what is this sheet about? Now this sheet is basically developed by Professor Aswat Damodaran. Now people regard him as a dean of valuation, and he is a very famous personality. So if you want to find out this spreadsheet, simply go to Google and search for Damodaran spreadsheets. And the first link over here, pages.stern, right? This will be the link where you can find the spreadsheets. Just scroll down and go to all-in-one valuation models and go to FCFF Simple Ginzu. This is the one. If you want, I'll leave a link in the description right here so that you don't have to find. So let's get started with the valuation. Before we go ahead, look at the financial. This is the quarter 2 ended financials for Shopify 2020. Okay, and this is last year's financial PDF, basically containing, it's just 14 pages long, okay, which is surprising. So most companies that have annual reports usually are huge, but this is fine. This is just a press release. This is not financial. So if you look at the data points, you can find so much data here. You're not supposed to get baffled by all this data. Okay, you just need to see what is the important data here. Now if you go to second quarter highlights, this is the latest financial data available. Look at the total revenue growth, which is 97% increase compared to 2019. So basically during lockdown and COVID-19, what happened is Shopify grew its users. More people went online, and it's just fine. I mean, I think it's okay because this was expected. Why? Because as whatever was there physically was shut down, people had to rely on something online. So Shopify was a source people used to set up everything, and now those users are probably there. Those who are making money will stay, those who aren't will go. So either way, Shopify will continue to grow. Now look at this. The monthly recurring revenue was up 21% compared to previous year's same time frame. You get my point. Why the share price grew in this 6 months period is because of this. If you look at before the COVID-19 outbreak, this is somewhere at that time. So people were anticipating this even in March, that the share price fell. People gradually, it was just volatile. People didn't know what to do. And then people understood, oh wait, this is about e-commerce. This is about online. So whenever you see someone not having an option to go out, people are going to offer online, right? People will be buying stuff online. So Shopify will benefit. And then look at the growth in share price, which is fine. But the share price literally doubled during this time frame. And it even went to 1,000 plus, which is where I feel market overreacted. And soon it understood that and started falling down. And using this, we valued Shopify somewhere close to $854 based on certain parameters, and we expect that will be the fair price where the share can be bought. Right now, the company is definitely overvalued. So what are the things we look at? We look at the financials, we look at these data points that I just talked about here, because these help you also understand what assumptions you need to use for future. Why do we need assumptions? Because for any valuation, keep in mind that discounted cash flow model basically tells you to take in consideration the future prospects of the company. You cannot understand what are the future prospects and you cannot estimate them if you don't have a reasonable basis for them and good facts that back that projection. So these projections are from year 1, that is 2021, to 10th year from now. So, and beyond that, it's terminal growth. We have considered something, I'll explain about that later on. So we got some revenues that are, this is the current revenue level. You can find data. Always make sure you use the trailing 12 months data. Now, where to find data for any company? Go to Google and search for Guru Focus and the company name. It will immediately give you what you need. Go to this link. The moment it opens, go to 30-year financials. It will give you the trailing 12 months data. Why is it important? Because you need data for 1 year, but this data in this spreadsheet is only for the quarter ended or maybe 6 months ended. So you basically subtract data for previous year's 6 months and add these 6 months. So mathematically it will take you time, it can be calculated, but it will take you some more time. Instead of that, just go here and look at this TTM column. So you can immediately find out data. If I go down, look at the income statement here, revenues. This is where I found the data. Now look at the revenue growth, right? The revenues are growing like crazy, but the company is not profitable. Look at the operating income. Keep in mind, in discounted cash flow model, we only look at the operating income. We do not look at the net income. Why? Because we look at cash flows, and this operating income is basically a cash income. Why do we look at cash flows? That's what the discounted cash flow model is, right? So we forget depreciation and all other expenses like amortization, which are non-cash. And then we look at them, and look at this, the company has basically increased its losses as it has increased its revenues. The reason is simple, it is incurring R&D expenditure. As it goes ahead, it is incurring more and more research and development. So if Shopify continues growing at this level, it doesn't make sense for people to invest in this company, because this research and development expenditure, if you remove that, the company has operating profits, right? Now, if I go down to cash flow, this is properly going to tell us what is the cash flow position. Look at the cash flow from operations. So their cash flow from operations are definitely increasing, okay? They are getting more and more cash out of their operations, no doubt. Look at the PP growth, it's steady, nothing too much. Purchase of investment. This is too much. They are buying businesses, okay? Then that is still fine. So they're spilling more cash in investment. Look at financing. So cash flow from financing activities is at that level. Issuance of stock. So they're issuing more and more stock. That's fine. That's completely okay. The issue I have is this: if you are not profitable, why would people like to invest in you? And look at the share price. It's at $876 per share. It's pretty high for a company that has no profits, right? So what we do is, I basically put down all these data points here. Once you understand the spreadsheet, once you download it, there's a lot of data here, and there are so many comments that Damodaran has put. I removed all of them. When you download it from that page, you'll find many comments that will guide you on how to use this sheet. For any doubts, you can reach out to me personally and reach out to me in any videos, any comment section. I'll reach back to you as soon as possible. So when you fill all these data points from online sources, you have some assumptions to make over here. Now these are the compounded annual revenue growth rate over next 5 years. I kept it at 50% because I think it's possible for this company. It's growing at a good speed, and basically people are going for e-commerce, and e-commerce is booming. So the previous year's growth for company, this is automatically calculated by the sheet using your input points. So green fields are not to be changed. And look at the US industry and the global average data. So Shopify has beaten the growth rates of the industry and also the operating margin. Now, it was wrong for me to consider a high operating margin. Look carefully what I have done here. I have considered 304 as the operating income, whereas if you go to the data point, you will find the operating income is not that high. It's negative, in fact. It is minus 139. What I did was I added back research and development, and I said this is basically an investment. Although they're expensing it out, this is basically an investment in the company. So I'm going to add it back to this, and I'm going to see what is actual profit. So I considered that as profit, right? And I have considered the reinvestment in this form over here later on in the form of R&D. So it is considered in reinvestment. What I'm saying is I will keep reducing the cash flows in the future that pertain to reinvestment to obtain the final cash flow that I get for all the years. How do we get cash flows? Revenues and the operating margins. You'll see the operating margins will remain fairly tight and good, and then finally they will settle down. But I think I need to reduce this a bit terminally because the company will reduce its margins in the future as more and more competitors emerge. So I think 18% would be a better measure, and I think this is fine. Also, a terminal growth rate of 2.2% is okay. Great. So what we see here is the company doesn't have any debt, and the cost of capital is relatively high. Actually, to be honest, relatively low for this company, considering it is not making any profits at all. So cost of capital is basically the discounting factor that is used in any valuation. Why? Simply put, the $1 you have today will not buy you the same goods tomorrow or day after tomorrow or in 1 year from now, because the value of money keeps on reducing. So the value of $1 1 year from now and value today won't be same. What is worth $1 tomorrow would probably be worth 86 or 85 cents today. How do we decide how much is worth is? And that is basically what we look at: risk. There is a risk factor that is associated to understand how much we want to consider as a reduction in the value of money in the future. Since you're taking more risk, you'll expect more returns. So it's directly tied to risk. You can see it keeps reducing as we go ahead because the company grows and the maturity levels are reached very soon and the risk comes down. So what exactly is cost of capital is basically expectation of investors. Now you can see I'm considering a premium, meaning 4.5% premium. What I'm saying is for a risk-free investment, that is the US government bond or the Canada, sorry, not US government bond, the Canadian government bond where Shopify is registered is 0.57%. So that is a risk-free rate. I'm saying for taking additional risk, I want additional returns of 4.5% here. So that is exactly how I have arrived at that cost of capital. Just put those data points. We will arrive and we will understand how to calculate cost of capital in future videos. This is just to give you a gist of how we carry forward with the valuations. And in future videos, I will not be discussing exactly how these numbers come in. I'll only concentrate on core areas about how cost of capital is calculated, how the valuation output sheet works, and what are the inputs, how to assume and make assumptions for these value drivers. Okay, what are these terms, year of conversions, sales to capital ratio. All these things will be covered in future videos. Don't worry, for now just focus on this. Now we have the present value of all the future cash flows. This is the future cash flow. How did you get it? Revenues minus margins, we get $769 million in operating profits, and we take the tax rate, and that's the effective tax rate. You can also find that on GrowFocus right here. You can find out how much tax they pay, but this is not going to be the case for every company, but this is the effective tax rate that will be there in the company's case. If it's good at paying taxes, if it's good at avoiding them, this will be the case. Why I considered this for Shopify is because when I went online, I searched for how much tax Shopify ends up paying. I came up with 11%, and I think it is going to remain same, and that is why I kept it at 11%. Now after tax deduction, you get interest, earnings before interest and tax, after which you deduct the investment and you get your free cash flow to the firm. Now you discount that future cash flow to get its present value. You can see $624 1 year from now will be worth $579 today. And the value for any company is the present value for all the future cash flows. So these are all present values for future cash flows. We take them over here. You can look at this sum. But beyond year 10, we also have some cash flows. For them, we also have formula, and it is calculated. I'll come to that formula in the next video. So that is the value of the future cash flows beyond year 10. That is the present value. That is 96 million basically. Sorry. No, that is 96,959 million. And for the next 10 years, it is 9,247 million. Okay. You add that up. Okay. Then you basically have your debt, which you reduce. There's actually no debt, but the company has operating leases that is considered as debt because it is essential for operations. If you don't pay that, you will be thrown out and your company won't work. Plus the cash. So we add the cash because it is an asset, and we get the value of equity. The value of options. What are these options? These are options that are provided to employees of the company. Okay, employees are given stock options. Now, why are we deducting it? Is because employees are usually given these options at lower value than the market price. And if a transaction is carried out at the lower value, what it does is simply reduce the value for the company in the market. So this is the value of equity, and this is in millions. So if you look carefully, this is $104,869 million of equity value, and I divided it by 122.75 million shares. I get per share value of 854.34. The current price is 914. It was at that time when we valued. Now you can see in the last 5 days, it did fall down after what we said, and there was a pushback. But this is a proper technical analysis here. You can see there is support and resistance coming in. So this is typical carrying out of the trend. Basically reverses for a short period of time and then goes down again. So I do anticipate it will come down to this fair value, and if it does, you know what to come, you know where to come, and you know what to do. So this is about how we value Shopify. This sheet is very detailed and complex. I suggest you get a hold of it, go through it, and once you are sure that you have some number of doubts, get back to me. Don't get confused. There will be many more sheets that are currently hidden. You can see so many sheets here. Just keep in mind, you have to only focus on sheets that I have kept on this presentation. Pay attention, input sheet. Just have a snapshot of this, or just pause the video when you come back later to check which all sheets I'm referring to. So thank you for watching. This is Wealth Workout. We expect Shopify to be worth $854 per share, and I think that is where we can expect the price to come down really soon. So thank you for watching. This is Wealth Workout. If you liked the content, do consider subscribing. Peace out.